Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with our friend and colleague, Chris Igou of DailyWealth Trader.
And today we'll also talk about the Fed, of course, again, and the JPMorgan Chase First Republic deal.
And remember, send your feedback to us at feedback@investorhour.com. Tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Okay, so two huge events happened this week. I think they're connected. We have JPMorgan Chase taking over First Republic on Monday. And then, of course, on Wednesday, we got the 10th rate hike by the Federal Reserve in their fastest, steepest, biggest, goodest, I don't know, whatever, rate hiking cycle since 1980, when Paul Volcker shoved the Fed funds up to 20% 4 times. And I think that, I know you've written some about this too, so I know that you have a lot of thoughts about this. And I certainly agree that there is an implied pause when they leave out some of that more hawkish language. But I think the market, if you look at the futures, the market has the Fed funds back to below 3% by December 2024. And even 4%, I think, by later this year, by December of this year. I don't see that. And I think folks just don't get how much Jerome has changed his mind. Here's what I think. People have heard it before. I'll repeat it just all in one place as a reminder. I think in the 1970s, Arthur Burns tried to lick inflation. He thought he had it licked. He didn't. So then Paul Volcker was hired to beat inflation, and he beat the daylights out of it, shoved the Fed funds up to 20%, blah, 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 and caused a big, brutal recession. And historically, we look back and a lot of people, not me necessarily at all, say Paul Volcker's a hero because he saved us from the ravages of inflation. And he restored the Fed's credibility, right? And so what happened after him to their credibility? Well, Alan Greenspan, Ben Bernanke, Janet Yellen, and even for the first part of his tenure, Jerome Powell, they were all these sort of extremely dovish types who their go-to move was just lowering rates at the first sign of trouble. And so people have gotten used to that. And I think it's wrong. I think Jerome definitely changed his mind, and I think he's looking at Paul Volcker and saying, see, I want to be just like him. I want to beat the daylights out of inflation once and for all. And if it causes a brutal recession, okay, Paul did it. I can get away with it too. And, I want a legacy for myself. I want to be the guy who did it, blah, blah, blah. I still think that is the right narrative.
Yeah, I think that's what he's set on. It's even when you hear him talk, Jerome Powell talk last week about, at the latest Fed meeting, he actually actively talked about a recession for kind of the first time, at any significant length. And he said, I hope we get a mild recession, but, that's not, that's a hope, right? Hope's not always a great strategy. And so, or something to always believe in. So, yeah, I'm kind of with you on, especially 2024 with rates going to 3%. That I have more trouble with that one than maybe to 4 at the end of this year. Should something happen, the rest of this year that causes them to hike rates a little bit. I think that's an underestimated point too, is if they cut rates, even if they cut rates, we're not going to zero again. That is not going to happen. And if the people that have been conditioned for that for the last 15 years, that behavior or that conditioning is just changing, I feel incrementally. But it's still not. It's still pervasive. As far as that's the recency bias, of that's all that a decent generation of people know, younger people who are in the financial industry, and so It's the same reason so many people got caught off guard in 2022 and couldn't imagine a world where stocks and bonds were falling at the same time. It's that sort of idea. And so, yes, if you're not thinking kind of that way that you're talking about, as far as Jerome Powell actually wants or is going to use the Fed's ability to fight inflation, that's until further notice. That's what they're doing. That's what the futures. And this last thing I'll say on it, the futures, if you looked at it a year back into the past, we're pricing in cuts probably as we're speaking a year ago, and that's obviously not happening. So there's a lot of stuff that needs to get kind of worked out of people's memory and be believing new behaviors.
Yeah, and if you look, like I looked through the FOMC statement, and I am sensitive to the hawkish language that is now omitted, the talk about, further rate hikes. Okay, but I went through and I graded every sentence, hawkish, dovish, or other, and I still wound up with there's 16 sentences, and I wound up with 9 of them hawkish.
Nice.
And who
needs Chat GPT when we got the Dan's
that's right. Yeah,
the Dan indicator here. I love it.
That's right. Dan's Fed grading service. It only costs $10,000 a week, or per meeting, 10,000 per meeting, and I'll rate every sentence.
All right.
So,
yeah.
But when they say things like economic activity expanded at a modest pace, I'm going to say that's neutral. But then, like, job gains have been robust in recent months, and unemployment rate has remained low. I'm saying that's hawkish, because that means, whoa, maybe there's still inflation. Then the next sentence is inflation remains elevated. Then the next sentence is the U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Not so hawkish, but you get it, right? It's like there's plenty of language left in there, in my opinion.
I think so too.
Yeah.
I think they're taking a step down, from where they've been, which to me means they're going to maybe hold rates at this 5%, 5.25% range for a bit. That's my opinion, and see what happens. But from there, I say there's reasons for inflation to go higher. Say there's something that kicks inflation higher. Are they going to cut rates in that scenario? I doubt it, unless, I don't know, they really need to. And I think Jerome Powell's read the books on the 70s and the 80s, and I think he knows. And so
I completely agree.
I think he knows, and it's not. I think he knows also that inflation's not going to get to 2% if they start cutting rates too. And it's. I think the Fed officials know that too. At one point, Powell said something like, so they asked him about his regrets of 2020 and 2021. I think the only thing he acknowledged was that he wouldn't have set a marker around that 2% inflation goal.
Right.
And so that tells you something that a lot of people, I don't think, heard.
Yeah, I'm still saying. So I'm just going to wrap this up and say higher for longer. What if you had to wrap this Fed thing up? What would you? I would say higher for longer.
Yeah, I mean, yes, higher than most people think for longer than most people think.
That's the thing, right? Yeah. Higher than the perception in the futures market for December or 2024. All right. So I want to talk about JPMorgan Chase taking over First Republic, because I don't like the narrative here either, because I think it's too much, bank failures can't be avoided. Jamie Dimon said almost something exactly like this on the call that they had Monday to talk about the deal. And it was, you're not going to have no bank failures, he said, but we have this process in place, and, this is about as well as it can work out. I mean, it sure worked out well for them. They're getting loans at a discount and securities, and they're not having to take all the liabilities on, and they get deposits, and they get loss sharing with the FDIC. They get 5-year, $50 billion worth of FDIC financing and an interest rate so good that they won't say it out loud in public. They were asked, the CFO was asked about it on the call. He said, well, we don't really want to say. So the thing that irks me about all this is that, what do we have? We have a bank, these banks that failed because they had deposit runs, plain and simple. And they had a lot of uninsured deposits, that is to say, deposits over the $250,000 limit. And then, when they fail, FDIC comes in and says, the government says, well, we'll insure all the deposits, okay? So if you're Morgan Chase, you're Jamie Dimon, you're sitting back and saying, they're going to backstop all the deposits. So those people are safe. And, the shareholders, they're taking risks, so they're screwed. It's going to cost me a lot less to take these banks over if I just wait for them to fail. Right. Because I know that the deposits are all going to be backstopped.
Yep, exactly.
And, the incentives are in place for a bad thing, which is for all of the, more of these assets and more of these deposits to wind up at too big to fail banks, right? Because JPMorgan Chase is too big to fail. The government will always save it. They'll always bail it out. They'll do whatever they have to, which means that Jamie Dimon's fortune is effectively backed by the Federal Reserve. There's something I don't like this.
Yeah. Yes.
I don't think this is the way this is supposed to work.
I think you bring up a good point. Yes. Backstop. That's the problem with backstops, right? I don't know what else to say. No, you're right. I thought similar when when I saw this announced, JPMorgan won the auction, right? And so they paid the most money, but in reality, it was not not a big deal for them to take this on at all.
No, and they won because they were willing to take some of the loans that other people weren't willing to take. I'm like, they've got 80% of the losses covered for 7 years on the residential and 5 years on the commercial. Of course, who didn't want the loans under that kind of a deal? I don't know.
Right. So you would say, if anything, obviously this points to consolidation in the banking industry, and some of these, the big get bigger, and yes, right, they are still too big to fail, right? And that's I guess that's the idea here.
They're too bigger than ever.
Yeah.
I don't think this is necessarily a good thing. I think that if we had real competition in banking, we wouldn't get the behemoths that we have. I think the only reason we have those behemoths is because the regulations make it harder to compete with the bigger banks, right? At about 10 billion of assets, and then at about 50 billion of assets, which is not that big compared to, trillions. The regulations kind of step up and get more expensive, and you need another 2 billion in assets to pay for it all. So, we've made it harder to compete. The regulations always have this effect, especially in finance. I was reading a book today that was written in 1873. Lombard Street by Walter Bagehot, very famous classic book about banking.
Original
banking
edition?
In England. No, I was reading it on Kindle.
Okay.
So I have a, they do those things where they take the original and they kind of almost like photograph it or something. But I can't read that. So I'm reading it on Kindle because my eyes are getting old and I read too much. And he described the exact same thing. And back then, the regulation was, I think it was called the Peel Act or the Act of 1845, maybe. And they wanted to restrict, they were getting worried about what they called joint stock banks, right? Joint stock being, stock, publicly traded, public banks. And so they restricted them. And Bagehot described exactly what I just said. They said, well, the guy who hated them and wanted them restricted, this Sir Peel, he became their greatest champion because then they didn't have any more competition after that because they made it impossible for new ones to come into existence. It always works that way. The incumbents are always right on the front lines of regulation. I'll never forget, like, when they were talking about licensing tax preparers, H&R Block was right up front. They were, yes, do that. Make it more expensive, because we'll pay for it for our tax preparers, but other people don't have that kind of money. So
my mind all of a sudden is wandering towards cryptocurrencies.
Bitcoin fixes this.
Bitcoin fixes this in a couple of ways, though. Well, we've just seen that it can and it can't, because we just saw what happened with I'm sorry, who is our friend, the fraudster? Oh my God, I can't believe I'm forgetting his name right now.
Oh, Sam Bankman-Fried.
Sam Bankman-Fried, right? Part of the reason he got into trouble was because he was allegedly pushing for regulations that would benefit certain parts of the crypto world and not everybody. And another crypto major called him out on it and started that whole, the whole thing, really. And
Sam was just asking for it.
Yeah. So that part is the bad part about cryptos that would lead you to believe like anything that happens in banking could happen there. But the underlying technology allows for individual people to not work through this Federal Reserve banking system, and could be a alternative if if enough people adopt it and it doesn't fly off the rails to the point where people call for regulation. It's like this, I don't know what you would call that scenario, but I think it's happened a lot throughout history, is what you're saying.
Right. It's just a standard thing that we get upset about some industry or another, so we regulate it, and the regulation hands the incumbents an advantage right away. I mean, if you were a tobacco company after the master settlement, you were golden. I mean, you were never going to have competition after that.
Right. Yeah, I mean, there's...
So, yeah. It's like, can you imagine coming into business and saying, the first thing you need to do is, pay every municipality in the country or whatever, however the deal was structured. I forget how it went.
Yeah, I mean, and look at the railroads too. I mean, it's so concentrated in like, 4 or 5 freight lines. And we see all the issues there, and so it's yeah. And so banking is heavily regulated, and it's consolidating like crazy. And the consolidation is it's always going to head back to the backstop, right? The backstop starts out as saying, just in case. And then it ends up being, well, the backstop is there, so we're going to run everything this way. It just naturally goes that way. You naturally will have a bad incentive as soon as you put the backstop in place. As soon as you say, Jamie Dimon's always going to be a billionaire because we will print all the money we need to keep him fat and happy, by printing all the money we need to keep his bank, bailed out. So, it's just a question of incentives and human nature and the way things go. Yeah. The other part of this story that this reminded me of, and that's the thing, like these things happen and people just like gloss over them sort of, that, oh, okay, this solved, one thing. But like, what are the consequences of it is what we're talking about, I think. And to me, this showed that the Fed and the Treasury don't want to cover all those uninsured deposits that they did with the initial crisis. They don't want to do that. I don't think they can afford to. I've already been reading stories about how the plans to replenish the FDIC fund. And so it's not, I think people forget, like, and this also came up on my mind with this debt ceiling, quote unquote, debate ongoing. They moved up the hard deadline for it because apparently they didn't get as many the government didn't get as much taxes in as they were expecting. I'm like, so wait, so taxes do matter. All of those economists that said, oh, we could just spend and the taxes won't matter.
Right. The MMT crowd.
Yeah, that whole crowd. Like, what happened? I feel like they've been proven like almost completely wrong to this point. So
yeah, another thing about that JPMorgan deal, now that you mention it, is the FDIC is going to pay out $13 billion in deposit losses. JPMorgan paid in as part of the deal $10.6 billion. So, they waited until it failed. They waited until things got really bad, and then they came in and used their balance sheet and their backstop and got a sweet deal. They recorded a gain of $2.6 billion on the closing of the transaction, and the restructuring expenses are spread over from now to the end of 2024 of $2 billion. So, by a conservative accounting, they're calling it $500 million accretive to net income this year. And JV Diamond says it was the cleanest way to get a clean bank, right? Because the assets aren't distressed, the loans and things, and the securities aren't great, but it's not like Bear Stearns, or Washington Mutual or something, both of which JP Morgan also took over. It's different. It's a clean bank. He said it like 2 or 3 times. Cleanest bank in the cleanest possible way. Like, okay.
clean bank. All right. He also said this part of the crisis is over. So,
oh yeah,
which hit me as a famous last words moment, but we'll see about that.
Yeah, I mean, there was a flirt like that day. He said that. He said the banking system is stable. Joe Biden said the banking system is safe and sound. Then on Wednesday, what did Powell said? Sound and resilient. And why? If it is, why do you need to tell us?
Yeah. Meantime, regional bank stocks like PacWest were down 40-50%, and it's
I know. Yeah. Which one goes next? I mean, by the market's accounting, it looks like PacWest. We'll see.
We will.
All right. Let's move on. Let's talk with our friend and colleague, Chris Igou. Chris has been around for several years around Stansberry. He's a young guy. I remember the first time I ever met him, I was really impressed. He's one of these people that, like Steve Sugarwood, is a magnet for these young, bright people. And Chris is one of them. We've never had him on the show. I'm really interested to talk with him, so let's do it right now. One of the most notorious months in the investing calendar has arrived with a bang. You've likely heard the expression, sell in May and go away. And after all that's happened this week, you may be tempted to act on it. But I can almost guarantee you've never heard of the earth-shattering Wall Street event headed straight for U.S. stocks in less than 60 days. Now, the date is all set. It's coming. 63 funds are actively preparing to send shockwaves through over $10 trillion of American wealth. And you have mere weeks to get ready before a wave of volatility crashes over half of the U.S. stock market. My good friend and brilliant forensic accountant, Joel Littman, is stepping forward to help you protect yourself and get ready on Wednesday, May 10th. If you have any money in IRAs, 401ks, annuities, pension plans, stocks, or bonds, I urge you to give Joel's warning your most serious consideration. It couldn't be more important to protect your wealth in the weeks ahead. Again, Joel will go live on Wednesday, May 10th with all the critical details. Head to warningfromjoel.com now to make sure you're on his list for updates. Again, that's warningfromjoel.com. Don't miss it. All right, it's time for our interview. Today's guest is a first-time guest on the podcast, Chris Igou. Chris is one of our colleagues and friends at Stansberry Research. And without further ado, Chris, welcome to the show.
Thank you, Dan. Excited to be here.
So, Chris, I just want to, give our audience a little intro to you, but I'd like you to do it. So you're involved in more than one effort. Tell me all the things that you're involved in with Stansberry.
Yeah, exactly. So I've been here 7 years. I've worked on stuff with True Wealth Systems. I've done review of market extremes. In the past, I've written DailyWealth, and now I'm working on DailyWealth Trader. So that's the main publication I'm focused on now. It's a trading service. And I mean, we buy stocks too. So we do anything from a month-long trade to a year-long trade, things of that nature.
Oh, a month to a year. That's pretty cool.
Yeah, yeah, exactly. Like, well, and it just depends on what we're looking at. If the goal is a short-term income opportunity, it's usually about 30 days. And if we're looking to buy a stock or recommend something longer, it's between 6 months and a year.
Neat. So, Corey, I bet you in your role of writing 5 or 10 times as many digests as I do, I bet you come across Chris's stuff even more often than I do.
Yes, I read Chris's work and try to share it a good amount, and it helps me too. As far as
I
and
appreciate
I've said
that.
this to him before. Yes, I enjoy it, and because personally, it kind of works with how I like to look at things with technicals and some fundamentals and sentiment. I think, or Chris could explain more about all that stuff. But yes, I think we just said something the other day about. I mean, you've talked about like tightening credit conditions too, and like all kinds of different things. So it's not just recommending trades, although you do that a lot too. So
yeah, there is definitely, 7 years here has been a macro type view a lot of the time. So I definitely take into account the situation, the market environment that we're in. And then I hone in on, what I want to recommend based on the technicals afterwards. So I try and have that top down approach. But when it comes to why am I making this trade right now, the technicals are a great way to say, okay, it's time to act. Let's do this right now.
So, Chris, I want to back up for a minute. How long have you been with Stansberry?
7 years. Yeah, April 2016 is when I started.
I want the audience to know what kind of investor you are. What is your core? And you came to us like right out of college, right? Is that correct?
That's right. For DailyWealth Trader specifically, if we're looking at long trades, if we're buying a stock, I definitely have the cheap, hated, and in an uptrend mentality. I worked with Steve Sugaru for a while, and that DNA is still very much in what I do. And we love to, like Corey mentioned, sentiment. If the market's really ignoring something completely, no one's looking at it, or it's the most hated it's been in a really long time, I love it. I want to figure out what's going on there and combine that with, the start of an uptrend, and things like that just lead to, you see it over and over again. You can make big gains that way. So that's kind of the core that I build around, whether it's, our longer term trades in investing, or if it's a short term trade. I look for ways that, a stock is either on a trade, it may have fallen too fast or gone up to the upside. Everyone's excited about it, say to the upside, and then you're like, well, is this overdone? Could it fall from here? So there's a bit of that DNA in everything I do for sure.
So rather than continuing to ask questions along this line, I'll just get to the point. Like all these guys down there in Florida where Chris works with Steve Sugaru and Brett Eversole and Vic Letterman and I forget who all else. There's a bunch of you down there.
Yeah.
They're all like math heads. They're just like, it's like math central. I just walk in there and I start feeling lightheaded because it's just too much math. So would you say then that you're a technically oriented trader, or how would you characterize yourself?
No, I would say that. And a lot of times we like to, like you said, we like to use history. So if we see some type of indicator that's worked really well for, buying into a stock or trading a stock, we'll back test that and we'll look at, hey, how's it done over the last 20 years, 30 years? And by getting that market history, we have a better idea of what the odds are when we make the trade. So I like to have data on my side for sure. And technicals are, like I said, probably the last thing I put in place before acting. And it's okay, this is why I'm acting now. We have the historical data to be, on our side, and, it's time to make the trade.
Oh, I see. That's interesting. And it sounds like a very sort of quantitatively oriented approach. Do you care about the difference between certain industries other than like trading price history or, technicals at the current moment? Like, does the difference between a mining company and a software company mean anything at all to you? Because, to a lot of quantitative people, it doesn't mean anything.
Yeah. And I actually, we look at sectors and different parts of the market. And I think it doesn't mean anything as far as when we're placing a new trade, a very short-term trade. Let's say, for example, we recently put a trade on short technology stocks, and the reason being isn't specifically that it's different than, another sector, but more it's like everyone's bought into that now. Everyone's getting into it as it's already up 20%, and it's run to the upside so fast. And there are several indicators showing that, it could drop lower in the near term, and that momentum is shifting. So those are the type of things that we look at on a trade basis. But certainly when we're looking at longer term trades or investments in that way, we take into account the different sectors. So it's kind of a two-part answer. It's on a short term, not really. I'm more worried about the technicals. On the longer term, yes, I want more quality and more value there.
Oh, okay. So longer term, it does mean something to you. For example, if a company is like carrying lots of debt, generates a lot of cash, consumes a lot of cash, et cetera, et cetera. Can you give me like the bullet points? Like what are the markers that mean a lot to you fundamentally in that regard?
Yeah. So a lot of times we trade blue chips, big names. You might see Walmart or Procter and Gamble or things like that. And so we're looking for big, steady, dominant companies in our industry that we can trade on. And one, we want to see, that they're growing, maybe it's top line, but we also want to see that they're not super debt heavy, that have free cash flow, and their margins, their net income margins are high. They're not single digits. We're not looking at something that is barely eking profit every quarter. So consistency at bringing in money and profits. And then we want to see that top line growth too.
Okay. So without giving away like any current, I don't want you to give away any current advice for free. I feel like maybe you almost have talked us through the process, but maybe you could just sort of put it all in one place. Like talk me through a trade from beginning to end for you.
Yeah.
It could be a past one or a hypothetical one, whatever you want.
Right. We can do a past one. So for example, let's say Walmart. Walmart's a big brand. Everybody knows Walmart. We traded that quite a bit. But if the company has recently pulled back and it's still in an uptrend, so example, using like the 200-day moving average, let's say it moved way above the 200-day and now it's pulled back to it. So the trend line is coming back to the 200-day and it's bouncing higher. That to me shows support in the technicals for Walmart to head even higher. So it's a good, solid company. It's in an uptrend and it's finding support at that level. We'll make a trade on that and say 30 days, we're looking for 2% gains over that 30 days on Walmart.
Okay. So if you're looking for 2% over 30 days, I mean, that's with the equity.
That's selling a put. So
selling a put. Okay.
Yep. So we sell a put, we earn that premium up front. And then if the stock stays above the level we think it's going to stay, then we keep that premium and the trade's over and we move on.
Yeah, that's a selling puts, man. Everybody at Stansberry fell in love with that thing years ago, and they've been beating it to death.
Hey, generating income. It's a good way to do it.
Right. Yeah. Yeah. Do you ever go the other way and do you ever buy puts or buy calls?
No, we don't. We haven't really done that, and I think the point being is those types of trades are really, we want to generate income. We want to keep money coming in the door. And by having those little singles, we'll call them, over and over again, like especially in a bear market, I think stocks are all over the place. We've had, you may look at the index like tech or the S&P, and it's like we've been trading sideways for 2 months, but I know Estee Lauder just fell, I think, 20% today. So
yeah,
we want to keep that income coming in the door. Even if we trade sideways, we're making money. So
yeah, and Chris, that's where I was gonna ask you just your thoughts on the market today. I know Steve and his team are rightly or wrongly known as bulls, most of the time, but I would dare say you've been bearish the last year or two. Why is that, what's kind of your macro outlook at the moment.
Yeah, that's accurate. For the first 6 years, I was definitely in the bullish camp, and now we all know the cost of capital has gone up. The Federal Reserve's raised rates to 5%, making it more expensive to borrow, tougher on companies to expand, and that's squeezing earnings margins. So you might be bringing in revenue still, but because the cost to do business is more expensive, those profit margins are getting smaller. So I don't think that's gone through the entire market yet. And one thing I look at is, if you look at the history of markets, back to 1945, stock market hasn't bottomed until the Federal Reserve cut rates, until they made conditions more favorable to grow. And we're not there yet. The Fed's probably going to hike today again. So we've got some time where credit's going to be tight and unemployment is still at 3.5%. So we're basically at full employment. And historically, unfortunately, you just don't bottom there. And last thing I'll say on that is, I think the biggest drawdown for the S&P was 25% peak to trough to October.
Mm-hmm.
Yeah, it's a pretty standard bear market drop, but throw in a recession, the average drop becomes like 40% during a recession for a bear market. So if we're headed for a recession, I think we still got some downside to this market. And that's kind of where I'm leaning. With everything so expensive as far as the cost to borrow, I'm waiting for that Fed to start dropping rates.
Yeah, I think you're not alone in that. So overall, and I generally get to this question with traders and like fundamental folks too. Overall, then, the macro picture, at least regarding interest rates, and you mentioned unemployment and rates, that does mean something to you. How close is the connection between the actual trades you put on and those macro factors?
Yeah, and this will come back to our short-term trades. They're very technical based. It's less of an effect on those 30-day trades. But when it comes to anything out further, it definitely has a more of a weight to it. And, we've actually put some, not throwing any advice out there right now, we've put some shorts on in certain parts of the market that we feel like, okay, I mentioned tech and recently and things like that, but that is certainly macro driven. It's got technicals to it, but the idea there is that the technicals are why we are acting now, and the macro setup is why we're taking that bearish stance overall. If that makes sense.
Yeah, shorting is hard, isn't it? It's just it doesn't even matter if the market's falling over some period of time. Shorting is just hard.
Absolutely. And we, the way I plan my shorts, I give it a very tight stop. So it's going to have, and if I'm wrong and it goes to the upside, I'll admit I'm wrong and it's over. But, then we're looking at, let's say I use a 5% stop with 15 to 20% downside based on the technicals and based on recent history. So I'm just trying to keep my losses small. And, when those hit, they'll have a lot of weight to other short trades.
Yeah. Also in the Sugaroo DNA, huh?
Yeah,
Risk
exactly.
management.
Small.
Yeah. Risk management is what Dan talks with a lot of our guests about, gets forgotten a lot of times, or never gotten to by enough people, I think. You
got to do it. And I think people, when you get invested or get so attached, married to your trades, and you don't set a stop, sometimes it's going to work in your favor. But I do think you got to admit you're wrong sometimes. You got to have that cutoff, and you got to make sure that you don't lose too much, so that when you're right, it way outweighs your little losses.
Right. There's a famous quote that I just can't grab the exact quote, but it's not how many times you win, it's how much you make when you win, and how little, should we say, you lose when you lose. Absolutely. All right. So again, I don't want you to give trades away for free that you have on right now, but are there particular sectors that are attractive to you at this moment as we speak in May of 2023?
Stocks wise, I think I'm more leaning to precious metals right now, I think, as far as a long play. Gold's been rallying as the dollar falls, and dollar's probably been falling for 6 months or so at this point, but it's coming off a 2-year high, or not 2-year high. It's coming off like a 20-year high, and it rallied for 2 years straight. So I think with the dollar going down in value, gold and precious metals in general, still have a lot of runway left. I think gold traded sideways for about 2 years, and people were saying like gold's dead. It's not the inflation hedge. But if you look at that 2 years, like the dollar was soaring, so gold was just holding steady as the dollar was up. And now that the dollar's falling, gold's starting to take off. So that's an area of the market that I'm, excited about.
Yeah, I like it. I'm holding gold and gold stocks, and I'm right there with you. And it's interesting, isn't it, how, you mentioned that 2-year period, people are saying gold is dead, and, gold is dead and Bitcoin is the new gold and all this stuff. And
Yeah.
oh, you're laughing at that. Okay, let's pursue that.
Oh, sorry. I mean, I don't know. It's I don't want to get. I'm not a Bitcoin expert. I don't know much about that space. More of a macro person to me. But usually, when you hear that type of call, it's a sentiment thing, right? It's hey, look, everybody's given up on this, and they're giving it up for this new thing, and it's like, okay, maybe the last 100, 200, thousands of years are today's different, but I'm not making that bet. And like I said, because of the dollar situation, it was just hiding that overall fact. It was like gold's not dead. It's just catching that headwind, and now that headwind's now a tailwind.
Dan, I will say regarding the Bitcoin discussion, and Chris, the last I've noticed a pattern the last, I don't know, month or so. Like when stocks have been down, the risk off trade has been gold, bonds, and Bitcoin's been up too on these days. And that hadn't been a thing, when tech stocks were down, Bitcoin was down. It's for some reason it's switched a little bit now. Now I don't know if that's like fear around a debt, the debt ceiling debate or whatever it may be, or who knows. But I will say that did get my attention, that Bitcoin's been going up on the days like gold and bonds have been up too.
I was thinking about that when I'd be curious to see Bitcoin from June or from August to October when tech fell and the S&P fell and all that, because there was a period in 2022 where risk on assets just tanked, right? And I think we've been in a period from, the start of the year till now where everyone's kind of like, hey, we haven't gotten the unemployment number spike yet. We haven't gotten these bad scenarios that people have been talking about. Maybe it's okay. Maybe I can get risk on and those kind of things. And we see this happen in bear markets all the time. You look at 2000, 2008, 2020, there are false rallies and people get excited or optimistic and they buy into it. And I think the reason for that is you have such a lag in the unemployment data. It takes a long time for it to actually, start to matter. And same with rates. The higher rates have to work their way through the system. So this kind of like, oh, we're okay, we're all good right now, so I'm going to go risk on again. I think there's a little bit of that playing into why people are buying Bitcoin. It's like, it's okay. But if we get that next leg down, that's when people are going to go, no, never mind. I don't want to own anything risk on. I just want to go back to protecting my wealth. And so I think there's a bit of that going on.
Yep. Unemployment's like the big laggard. Like when that has spiked up or it's been going up for months or whatever the case, that's when you start getting bullish.
Exactly.
You're bearish when it's low, really low, too low. Yeah.
Yeah. And if you look, the Federal Reserve, their latest expectation for the end of the year is, I think, unemployment to be at 4.5%. So they're telling you that they expect things to worsen. And I think everybody right now is still kind of saying, hey, the Fed is going to stop hiking. That's great, and they don't see what comes after that. The Fed is saying like, hey, our job is finally working. We're slowing down the economy. And that could be the next catalyst that sends us back lower. We'll see.
Right. Yeah. I mean, we will see, won't we? Earlier you talked about bear market performance and then bear market performance with a recession. And I wanted to get back to that for a second because obviously you're a really data-oriented kind of a guy. So for you to sort of telescope in and, shrink that data set from bear market merely to bear market, during a recession, you got less data to work with. And in general, that's, less whatever reliable,
Right.
or you can impute a probability with less, confidence, let's say. And so I want to know what you think of what I've done, which is like I've gone completely off any ability to impute probability and just gone totally anecdotal and said, well, not just an average bear market, but a bear market following an absolute financial mega bubble, 1929, 2000, Japan, 1989. I mean, you could say there's no data. There's so little. There are so few instances, but I'm saying this is one of them. And so when you're talking about, 25% average bear market, 40% with a recession, I'm like, no, 75.
Right. Yeah. I mean, you're definitely in the rare territory. But if you look at, we talk about sentiment. If you look at 2000, 1999, and how crazy everyone was for tech stocks, and we saw that bubble unwind. 2021, I mean, I wasn't in the market in 1999, but God, I had friends texting me that had never bought stocks in their life, buying NFTs, and they were buying Bitcoin, and they were doing all of those things where I was like, 6 years in or so, you guys have never texted me about buying a stock, and now it's like they were getting into the riskier stuff, and so I think sentiment was extremely bullish, back then, and we've come off that certainly, and it's been more, over a year since then. But if you're taking enthusiasm, a bubble situation, yeah, I can see it. It adds up to those 1929s, 2000s, the bigger bust. So I'm not saying down 75%, but
you're not saying it can't happen either.
Yeah, exactly.
Yeah. It's a cult, Chris. We're trying to get you in the cult.
No, but it is a good point about bear markets with or without recessions. It's something, probably a couple months ago, we were at this point where that was a question, and then it kind of went away because like, the recession isn't coming because we haven't seen it yet. But now, I think it's kind of back, or it should be on people's minds at this point. And yeah, it would make a lot of sense. The market, it doesn't need to be rational, but it would make a lot of sense that we've had this rally / sideways action for a while now that could break one way or another.
Yeah, and it's you look from June to August, I think the S&P soared 17% over that 2 months. And I think we're about 16, 17% off the October low right now. So because it's been grinding higher for more months, it kind of feels like, okay, is this the real McCoy? Are we heading into a bull market? But just like from August to October, it can turn right back around and head back to that low in no time. So I do agree with you, though, that in around probably June 2022, when a lot of people were saying, okay, the recession's coming, and that lag in data has just been taking a long time. That's the optimism happening in there eventually. And now we're getting to the point where I think GDP came in at 1.1% growth for the first quarter, and it was lower than expected. I think they had 1.9% as the expectation. And the conference board, it has the probability of a recession around 99%
is that all?
now.
Okay.
So, yeah, exactly. But yeah, we'll see. I mean, that's the thing. It's, I think we're getting close. And again, first 6 years of working here, I was bullish. I just think as you're in these bear markets, you got to be smart. You don't want to just be trying to jump the gun on, hey, it's time to buy it. We want to peg the bottom. I think it's a very dangerous game to play. And history shows that there's likely some more pain in the coming months.
All right. I told you he was on our side anyway.
Just a little bit. Not saying 75%.
No, I'm totally messing. Yeah. Totally messing with
All
you.
good.
Actually, though, I do want to get one more, like you said, okay, gold stocks, that's kind of looking favorable to you right now. You got another one for me? Just like sector that has recently come on your radar screen or something you like?
Yeah, I mean, thinking about long positions, I say precious metals in general, but commodities have even started to pull back a little bit. So I think we take more of a individual stock approach in that aspect rather than looking at which sector overall, especially in our 30-day trades and such. And so really I'm trading for income right now the majority of the time. And at some point there'll be the right time to get long a lot of things. I just think that last drawdown is when you get the puke point, And if we look at previous bear markets, going back to I think 1990, small caps, the Nasdaq, and the S&P all bottom around the same time. Like if not the same day, within a couple weeks of each other. In this bear market, the S&P bottomed in October, tech stocks hit a bottom in December, and small caps were in June. So they're all spread out. We haven't had that moment. So I think I'm trading for income right now, keep the money coming in, and once we get some of that shake out, then I'll be more optimistic on different sectors.
I like the sound of that. I like that observation that these sort of different bottoms, that are months apart, kind of show you that we're not at the big bottom yet. I think that's a nice simple handle for folks to kind of grasp onto, because let's face it, in a real bear market, you do get this like one final panic where people basically give up on stocks, and some of them don't come back for years. And the action just doesn't suggest that we've seen that. That's great.
Exactly. And to the last point to that, the third drawdown or the last drawdown of a bear market is usually the biggest one, or near the biggest one. So it happens quick, and it's pretty rough when it happens.
All right, Chris, I think it's time for my final question. Unless Corey has anything else for you. All right, here we go. So the final question is the same for every guest, no matter what the topic, even if it's a non-finance topic. Exact same final question. And it is simply, if you could leave our listeners with a single thought today, what would it be?
Oh, wow. I would say, that's a big question. I would say for the markets, and I'll keep it in the markets. How about that? Playing defense right now, as other people are saying, all right, it's time to get in. This is the new bull market. It may feel like you're being left behind, but that's, earning income, playing defense in this kind of market, surviving the bear is the important thing. And when the bull market comes, we'll be ready for it, and it'll be time to profit. I think that's the best way to look at it.
You are wise beyond your years, sir.
Oh, man.
That's a self-serving statement because, I agree with every word of it. But thanks for being here, Chris. It was really great to talk with you.
Thanks for having me. This has been great. Fun to be on.
Yeah. All right. And, we'll give you a call in another 6 or 12 months and see how this bear has progressed and talk some more.
Sounds like a good plan.
Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. And he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. As a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. If you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at www.rollingcrash23.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap Inc. before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to www.rollingcrash23.com for your free copy of this new report. I thought that went very well. What did you think? I thought it went really well.
Yes, me too. I'm not surprised also, actually, just reading his stuff all the time. Yeah, he does good stuff.
So it doesn't surprise, a couple of things don't surprise me. That he's still here after 7 years or whatever it's been, and that he's just kind of done better and better and grown in his position. That's I have to give some credit, of course, to Steve. He has attracted these people, like, Brett Eversole, Vic Letterman, Chris, and I know I'm leaving someone out that isn't coming readily to mind, but he just seems to attract these really bright young people. They read his letter and they say, I want to work for this guy. I think when he talks about surfing, that helps too.
I think so. Chris is a big surfer too, I think, from what I remember. So, but yeah.
Well, he's already in a cult, so we shouldn't try to get him in the bear cult, right? So he's in the Sugarroot cult.
He's in the, well, that's why I kind of asked him, because he is like the bear in the Florida office, which is interesting. So I wondered how he handles that. But he does look at it like so short term that, it's and long, like he was saying, that like there's no reason to be super bullish right now. So
right. So he'll and you're right. On the flip side of that, maybe there's no reason to be bullish right now, but if there is a reason, like, he'll change his mind a lot faster than I will,
right? Because
I'm looking for this mega trend, and he's just looking at technicals and history, and
right, exactly. So yeah, I don't know, I thought it went well. Glad he's doing more stuff.
Yeah, and I hope our listeners will, maybe check out. You can just go to stansberryresearch.com and type his name, and you'll find out stuff about him. Very bright young guy. I think he's going to be with us for a while. He's I think he's hitting his stride. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. And do us a favor, will you? Subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.